It's been 2 weeks since I did my video of retail investors are fearful when they should be greedy. We had the fear and greed index. It was sitting all the way up to extreme fear territory. We had a lot of fear videos and just people calling for another kind of 2008 or another market crash. I mean, I got so many comments of people thanking me because I'm putting some bullish thesis in the market while everyone was making bearish videos. But this is typically what happens. People and on YouTube, they make bearish videos whenever the market's going down, but then they make bullish videos after the market goes up to kind of avoid being wrong. But I saw a lot of fear and a lot of misconceptions in the market, and since then the S&P is up over 10%. It was not intentional. I was not trying to call the exact bottom or anything crazy, but I just saw a pretty amazing buying opportunity. But I also saw a lot of investors just finding any kind of reasons to not buy into the market because we have geopolitical issues, the Fed is about to cut rates or about to hike rates, or all kind of reasons. And I learned it the hard way that the best time to buy is when it's not easy to buy. And the market doesn't bottom on good news. The market bottoms on bad news. In March 2020, we bottomed on bad news. Whenever we had the SVB stuff, we bottomed on bad news. We had banks failing, people calling for another 2008. This is exactly where the market bottomed, when people were calling for another 2008. And the same thing happened in 2009. People were saying there's no reason to be bullish, but yet the market priced it in, we recovered, and then everything went up. And the only way you could look at that stuff is if you focus on the valuations and not just on the macro factors on their own. Now, a lot of you might have missed this rally. Maybe you have a lot of cash on the side. Maybe you're kind of, a little bit confused of what should you do? Should you just go all in right now? Or what should you do in general? Well, I personally don't really care where the S&P 500 is, as I don't buy the index itself. I look for different opportunities within individual stock picking. This is what I do. Now, in this video, I'm going to tell you exactly where I'm finding a lot of opportunities in stocks that have yet to catch up to the S&P 500. And this is the most exciting thing to me, is whenever I find something that's undervalued and it's not really correlated to the index yet, or maybe it just hasn't caught up to the index. And sometimes these stocks, they sit flat for months and months, and all of a sudden they just go up and then they match the S&P. It happens so many times to me. I mean, I had these stocks in my portfolio. My portfolio was flat between February and June, just flat. And then suddenly between June and August, I mean, my portfolio went like crazy. All these stocks that were sitting flat went out of nowhere and they caught up to the S&P 500. So I'm going to tell you some of those opportunities in this video. I think it's going to be very, very helpful, and I really hope you enjoy it. Now, the first thing I want to talk about, which I talk about in pretty much every single video, and it's just absolutely stunning, and this is the Magnificent Seven outperformers. Now, the S&P is up 15% year to date. The Magnificent Seven are up 95% year to date, and the S&P 493 stocks, the remaining stocks, are only up 1.3%. So this is the biggest misconceptions that investors have. They say, oh, but there's no fear in the market. There's no fear in the Magnificent Seven. But if you look at the 493 stocks, there's still a lot of them sitting pretty close to 52-week close. If you look at a lot of the small cap indices, they've been flat for 5 or 6 years. I'm going to show you one index that's been flat for like 15 or 20 years. And it's been absolutely insane among the other stocks. But if you just look at the Magnificent Seven, you're going to miss out the bigger picture where you have so many opportunities in the 493 stocks. And this is what I'm really going to try to focus on in this video. Now, this rally was largely due to rates maybe peaking, maybe finally peaking, and they are maybe starting to come down pretty close to where they were before, around 3% to 3.5% on the 10-year. I mean, this is key to a lot of valuations, especially among growth stocks and many others. Now it's around 4.4%. It looks like it has peaked and it's headed lower, but we did have such periods before where a lot of people saw that rates were peaking, but they were not peaking. They just kind of did a small peak and then they went down and then they went on another run. So that could be it. But to me, where the Fed is and where inflation is, I believe rates has most likely peaked and they are headed lower. So any kind of investment that I want to make, I want to mainly bet on interest rates going lower. Now, I cannot bet my entire portfolio on that. Like if the stocks are completely trash, like for example, something like Rocket Mortgage. Rocket Mortgage is going to go up a lot if interest rates are coming down because they are very sensible to interest rate. But it's not the best business model in the world. So you want a good business that's undervalued that could also massively benefit from interest rates coming down. And this is what I'm going to try to give you some of the stuff in the video. But something else about the Magnificent Seven, and this is another stunning chart, and I am not sure how accurate this graph is, but it's done by I believe, Goldman Sachs, and this is the exposure of hedge funds to the Magnificent Seven. It's over 99%, 99% exposure to the Magnificent Seven. Now, the hedge funds aren't the smart money as you believe. They're not smart at all. I mean, if you look at their previous exposure, in January 2022, they were max exposed to the Magnificent Seven after they rallied in 2021, 56% exposure. And then what did we have? We had the biggest pretty much crash in 2022, a very big crash. Now, after the crash, after all the Magnificent Seven stocks had a horrible year, their exposure was only 12% at the bottom. But at the top, they were around 56%. Well, now their exposure is 99% to the Magnificent Seven. So what do you believe is going to happen after? We might have a pretty big reversal in these kind of Magnificent Seven stocks. I'm not saying it's going to happen tomorrow, but we could have such things. Now, the beauty about it is that once these Magnificent Sevens peak and they start to go on the way down, you're going to have a lot of other stocks that are going to outperform despite the big seven coming down. It happened to me in 2022. This is why my portfolio was up 27%, because I was exposed to stocks that were not participating in the Magnificent Seven rally. And once the Magnificent Seven stocks started to come down, my stocks were going up 10, 20, 30, 40%. And I talked about those stocks many times on YouTube. A lot of you that watched me in 2022 are likely familiar with those stocks. So this is the kind of opportunities we could have in the future. Maybe everything just rallies together and the Magnificent Seven never comes down. But if this is true and their exposure is over 99%, it would, encourage me to look somewhere else for a little bit better value. Now, one place I'm looking at, and I cannot give you individual stocks because they're like 50 million market cap and 60 million. It's mainly micro cap stocks and small caps. I talk about them in my own group if you're interested in joining, but maybe you could put it up on a screener or look at some ETFs. But this is the TSXV chart. This is the TSX Venture Exchange, mainly micro caps, illiquid stocks, small caps, and all these kind of things. Now, this ETF, after we cut rates from pretty much March 2020 to the peak, this ETF or chart or whatever you want to call your index was up something pretty close to 182%. This is a very, very kind of related to interest rates and stuff, 182%. Now, I'm not saying it's going to go up 182% again, but this is where I'm finding a lot of value. This index has been pretty much flat for like 10 or 11 years. And it's the same thing with a lot of the UK indices, the UK small cap and mid cap index. You could run up a screener, you could find amazing buying opportunities in these kind of indexes or in these kind of exchanges. It's pretty amazing stuff. I would highly encourage you to look over there. Even the Canadian index itself, the TSX, is not bad at all. A lot of opportunities in Canada. But something else where I can give you individual stocks, and this is something I've been bullish on for a while, but it has a long way to catch up to the S&P 500. And if interest rates are really peaking and they are starting to come down, there's pretty exciting opportunities in stocks that haven't gone up yet. If I was 100% cash or 50% cash, which I'm not, I'm at my lowest cash position I've been. But some stocks that have yet to really catch up to the S&P 500, if you're sitting on a lot of cash, I think you would like such things. And it's mainly the dividend stocks. Now, the dividend stocks are not attractive because we have higher interest rates. Investors can get 5 or 5.5% risk-free with something like treasuries or money market funds or whatever you want to call them, these kind of products, 5 or 5.5%. So the argument is, why should they go into dividend stocks, get to 4 to 5%, but take on more risk? Well, this makes perfect sense. But, something like money market funds, if interest rates are peaking and they're going to eventually start coming down, I believe they're going to come down in 2024. I know the Fed said they're not going to do that. This is, what I personally believe. And you have a president that might come in 2024 if he gets elected, Donald Trump. He always fought with Jerome Powell about lowering interest rates. So we have all these things coming together. And for me personally, I would like to be positioned ahead of time before we get closer to such events and then everyone jumps all at once. I would like to be positioned beforehand. And it's mainly dividend stocks. Now, this is the year-to-date return for a lot of the S&P stocks. Now, 100 stocks without dividends, they are up something like 9%. 100 stocks of the highest yielding dividend stocks in the S&P, they are down around 8%, which is pretty insane. Now, you could mainly see it in this illustration here. And this is pretty much the NASDAQ ETF and a high dividend yield ETF. Now, the NASDAQ ETF is up 45%, while this ETF is still down 10% after, after this whole rally. It's still down 10%. And then you have the QQQ, which is up something like 45%. And they were pretty much going together in early 2021, and then once interest rates started going up a little bit, they got out of favor, and this is what happened. Now it's sitting at a 10% loss, and you get a pretty good dividend on such ETFs. But I have other stocks that I talked about on the channel, and I'm still pretty excited about them. It's mainly within REITs. I mean, the REITs had a huge drop one day, like 4 or 6%. Something like Realty Income was up like 5% in one day. It was absolutely stunning. Then they sold off a little bit, but something like Realty Income, I mean, if you look at their return year to date, it's down like 17%. And apartment REITs that I talked about, Mid-America, they own apartments in Sunbelt area and many other places, is down like 20%. So if I was cash heavy and I missed this rally, I would be looking at the stocks that have yet to catch up. Something like the dividend stocks that would look very attractive. If interest rates are coming down, you could lock in like something Realty Income, a 6% yield forever. Even after interest rates come down, you're still going to collect this 6% paid monthly. And this REIT is growing, and you could potentially get price appreciation whenever interest rates come down. The 6% yield is going to be more attractive. So this is what I would be looking for if I'm one of the people that missed on this rally. I mean, maybe we're going to reverse and make a new low, but I'm not personally seeing it. This is a pretty bullish chart, a bullish breakout. As I said in my videos, I would not be worried about anything unless we go below this trend line that we formed in March 2020 and on the October low. If we ever get below this trend line, then, I mean, I would be worried a little bit. Maybe I would raise some cash position or do something like that. But as long as we're above this trend line, and so far we have been above this trend line, I am personally not too worried in terms of a technical standpoint around the, S&P. Yes, it's a little bit expensive, but the market has stayed expensive for years and years. So there's never going to be the perfect time. I would be looking at opportunities. I like small and micro caps. They're going to perform amazingly well with lower interest rates, and they have yet to catch up even to the growth stocks like ARK Innovation and other ones, something like the TSX Venture, a lot of stocks in the UK. I talk about them in my own investment group, or maybe REITs or just dividend stocks in general that have yet to catch up. So this was not financial advice. It was just my opinion on the whole market. Thank you so much for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.